One three-digit number is quietly deciding your whole financial life right now. It controls the loans you get, the rates you pay, and even the apartments you can rent. And most people have no idea how it actually works. This is your credit score, and it follows you everywhere. Lenders use it, landlords check it, insurance companies and even some employers peek at it. One bad number can cost you tens of thousands of dollars over your lifetime. Now for the good news. Once you understand exactly how this score gets built, you can take control of it. It's not magic and it's not random. It runs on 5 clear factors, and today you'll learn every single one. First, the scale. Your FICO score runs from 300 at the bottom to 850 at the top. Nobody's born at 850, and almost nobody hits it. But knowing where you stand tells you exactly how much room you have to grow. Roughly, 800 and above is exceptional. 740 to 799 is very good. 670 to 739 is good. 580 to 669 is fair. And anything under 580 is poor, where loans get expensive or get denied completely. Why does climbing those tiers matter so much? Because on a 30-year mortgage, the gap between a fair score and an excellent one can mean paying tens of thousands of dollars in extra interest. Same house, same loan, wildly different cost. Now the heart of it, the 5 factors. The biggest one by far is payment history at 35% of your score. This single factor asks one simple question. Do you pay your bills on time, every single time? Just one payment 30 days late can stick to your report and drag your score down for years. And the heavy hitters, collections, defaults, and bankruptcies do the most damage of anything in the entire scoring system. Think about that. More than a third of your score comes down to a habit you fully control. Paying on time isn't flashy, but it's the single most powerful thing you can do for your credit. Consistency wins here. Factor 2 is amounts owed, worth 30%. This is mostly about credit utilization, a fancy phrase for how much of your available credit you're actually using. And it matters way more than most people ever realize. Now the math. If you have a $1,000 limit and you're carrying $900, you're at 90% utilization. That screams desperation to lenders. Carry just $100 and you're at 10%, which looks healthy and responsible. The rule of thumb is to keep utilization under 30%, and under 10% is even better. The lower you go, the better you look. High balances signal risk, and risk is exactly what lenders are scoring you on. Factor 3 is the length of your credit history, worth 15%. This one rewards patience. It looks at how old your accounts are, including your oldest account and the average age of everything you've got open. Older is better here, and that leads to a huge mistake people make. They close their oldest credit card thinking it helps. It doesn't. Closing it can actually shrink your average age and quietly knock your score down. So that ancient card you opened in college? Keep it alive. Put one small recurring charge on it, pay it off, and let it quietly age like fine wine. Time is doing free work for your score. Factor 4 is your credit mix, worth 10%. Lenders like to see you can handle different kinds of credit. A healthy blend of revolving credit like cards, plus an installment loan like an auto or student loan helps a little. Don't go taking out a loan you don't need just to chase this. It's only 10%. But if you naturally have a card and a loan paid responsibly over time, you'll tick this box without even trying. Factor 5 is new credit, also worth 10%. Open a pile of new accounts in a short window and lenders get nervous. It can look like you're suddenly scrambling for cash, which is a red flag to them. That brings us to inquiries, and there's a key difference everyone should know. A hard inquiry happens when you apply for new credit. It can ding your score a few points, and several in a row add up fast. A soft inquiry is totally different. Checking your own score, getting pre-approved offers, an employer peeking, none of that touches your number at all. So go ahead and check your own credit as often as you like. Sit with that one. You can monitor your own score all day long and it stays untouched. The myth that checking your credit hurts it? Completely false as long as it's you doing the checking. Now, ever notice your score is different depending on where you look? You're not imagining it. There are 3 big credit bureaus, Equifax, Experian, and TransUnion, and each can hold slightly different information about you. On top of that, there are multiple scoring models. FICO 8 is the most common, but there are newer FICO versions and a competitor called VantageScore. Different model, different math, slightly different number. That's why they rarely match exactly. So don't panic over a few points of difference between apps. Focus on the trend. If all your numbers are climbing over time, you're winning, no matter which exact score you happen to be staring at today. Okay, so how do you raise each piece? Time to turn all 5 factors into a simple action plan you can start using today. Each lever has a clear move, and together they compound into real results. Step 1. For payment history, never miss a payment. Set up autopay for at least the minimum on everything as a safety net. That one move protects your single biggest factor while you sleep. No more accidental late marks ever. Step 2. For utilization, pay your balances down and keep them low. Try paying before the statement closes so a smaller balance gets reported. You can even ask for a higher limit, which instantly lowers your usage ratio. Step 3. For length of history, keep your old accounts open. Resist the urge to close them, even ones you barely use. Their age is silently helping you, so let those accounts sit there and keep getting older. Step 4. For credit mix and new credit, only apply when you genuinely need it. Don't chase sign-up bonuses by opening 5 cards in a month. Space out applications, and let your mix build naturally over the years. And now the bonus move almost nobody actually does. Pull your free credit reports and read them line by line. You're legally entitled to free reports from all 3 bureaus, and errors on them are shockingly common. A wrong late payment, an account that isn't yours, a balance that's already paid off. Any of these can be silently crushing your score right now. Spot them, dispute them, and you could see a jump for doing basically nothing. Think of it as free money sitting on the table. 20 minutes reading a report could fix an error that's been costing you a better interest rate for years. That's one of the highest return tasks in all of personal finance. Now the part I really want you to take away. Your credit score is not some mysterious judgment handed down from above. It's the predictable output of 5 factors, and you have your hands on every single one of them. Nobody fixes their credit overnight, and that's fine. This is a marathon, not a sprint. But every on-time payment and every paid-down balance is a brick in a wall that opens doors for the rest of your life. The person who understands these 5 factors will quietly pay less for everything, from cars to homes to credit cards, than the person who doesn't. You just became that first person. Now it's time to put it to work. Let's lock it in fast. Payment history is 35%, amounts owed 30%, length of history 15%, credit mix 10%, and new credit 10%. Memorize those 5 and you understand your entire score. Pay on time, keep balances low, hold on to old accounts, build your mix slowly, apply for new credit sparingly, and check your reports for errors. Do those things consistently and your number has nowhere to go but up. Quick question for you. What's your current credit score range, and which of these 5 factors are you going to work on first? Tell me below. I read the comments, and your story might just help somebody else. If this finally made credit scores make sense, give it a like, subscribe for more no-nonsense money breakdowns, and share it with someone who needs it. Your future self and your wallet will thank you. See you in the next one.